And we are live. What's going on, guys? It's Ricky with TechBud Solutions. Hope that you guys are all having an amazing Wednesday. Today is a very important day because today is the Fomc rate decision. I'm going to start sharing my screen so you can see exactly what it is that I am looking at. We have the NASDAQ market still in the green and very, very close to previous all-time highs, right? We talked about this in today's earlier video. I talked about this yesterday. Again, markets with a really nice rally just moments before a very critical point. So if you think that the markets are going to break out and make new highs, feel free to go long. If you are uncertain and because of a potential pause and because of up and coming earnings from big tech, right? We have Microsoft, Meta, and Tesla reporting in just a few hours after the markets closed. A lot of these companies have been lowering their guidance. We'll be seeing if they lower or they come in better than what is expected. The part that I'm most excited for out of all of these is Tesla. Tesla, this will be the first time that Tesla reports earnings without the incentives and being subsidized by the government. So I'm interested to see what their bottom line looks like and to see if they're still going to be a growing company, right? So in the next 8 minutes, we will see what the rate decision is. So I'm going to give it a few seconds for people to be able to start tuning on in. Once you guys can hear me and see me, we'll kind of get into the details of what to kind of expect for today. There's the rate decision, and then 30 minutes after, there is the press conference. So you guys let me know once you guys are ready, and then I'll pull it up for you guys, okay? So we are just 8 minutes away. FOMC statement, which is the rate decision, and then the press conference is 30 minutes after. So Ricky, if you can talk about silver. I don't really feel like there is much to talk about when it comes down to silver. I'm definitely open to entertaining the conversation, but I don't think it's a good deal. I think there's a reason a lot of people are talking about it. It just reminds me of any speculative asset after it kind of takes a leg of its own, right? It's doing its own thing. There's a lot of momentum behind it. There's a lot of hype behind it. I think that's amazing for those that are making money as it pushes up. But we know that those conditions are not long-lived, right? Eventually the correction will happen. Silver is not sustainable at these elevated levels. It was trading at $20 to $30 an ounce for a reason. It doesn't mean that it has to go crashing down by next week. It could still continue to pump as long as markets support those irrational valuations. I would just be very careful. So if you want to go long, I welcome it, right? Feel free to do whatever it is that you want. It's not for me. And just because it's not for me doesn't mean that you can't do it. So I just think the risk is much greater than the potential reward. And that's just my opinion. I'm not here to debate you. I'm not here to try to convince you. That's the last thing that I'm here to do. I say that if you're bullish on silver and you think that it's still a good deal, put your money where your mouth is and buy more silver, right? For me, it's not a good enough deal, but it's bullish enough that I don't want to short it, right? That's why none of my videos where I talk about silver, not one, have I ever talked about shorting silver, because I know that there's a lot of momentum. Although there's big institutions, to my understanding, I think JP Morgan opened up a big short against silver. Guess what? JP Morgan has a much larger tolerance than I do. So they're probably fine getting in a little bit early. They can stomach it better than me. I'm not them, right? So because of that, I'd like to kind of stay a little bit more patient, be a little bit more calculated. The past 48 hours it's paid off. That's to say the least, right? For all my LPP members that are in here, you guys tell me what you think, right? Holding back and not shorting Intel has been, staying patient, staying cash, right? No open position on INTC, just so you guys can see here. It's really paid off because now it's ran up high enough where if markets do begin to correct, now we have decent downside. This is the beautiful thing about really waiting for a setup to form. Not that it has to happen, because it still can push up higher, right? I've stayed this patient so far, but it's been really cool to really challenge myself during a very volatile time and staying patient and being calculated. So congratulations also to all those that went long. I mean, the setup was there for those that, caught the dip. You saw it begin to show signs of a support. The signs were there, right? And then the momentum picked up yesterday and went into today. So again, we're all here for the same reason. It's to make money. Let's not pretend like we're not. My thing with Intel, and again, it's just my opinion. When you head on over to Investing Pro and you type in Intel, for me, it's crazy to think that a company that trades at a $240 billion market cap, based off of its most recent earnings, it has a net income of $26 million. Come on, guys. It has a negative 821x PE ratio. For me, that's laughable. But again, I know that irrational markets can support irrational valuations for a long time. So because of that, I just want to stay patient, right? And again, if you guys don't have access to Investing Pro, a lot of you guys have been commenting on it based off of the series of videos that I made when it came down to talking about, American Airlines and the different airline companies. And we did a quick little fundamental analysis. I used it yesterday in my UNH video for United Healthcare. UNH, also, if I'm not mistaken, it was up. I'm actually not too sure if it's still in the green. Let me double check. Yeah, it's up 4%. Not terrible, right? After selling off to lows of 280. For the few of us that were okay with buying the dip, it's a dead cat bounce. I don't expect it to recover anytime soon fully, but it's up 4% today. I like that. And we're able to dive deeper, right? When you want to learn more about a company, you could click on their pro research and you can actually see not people's opinions, but the actual data. And that's the thing that I'm here to remind you is that if you're trying to make more informed decisions, if that's your goal for 2026, the first link, it is an affiliate link. I want to be straight up with you guys. The first link will offer you 55% off plus an additional 15% off. That means that if you were to sign up for it, it's less than $9 a month. And that's a simple question to ask yourself. Is having access to this information worth $9 a month for you? And if the answer is yes, great. First link down below. If the answer is no, I respect that, right? You can still check out and maybe learn more about the software and, sign up for it whenever it is that you see it to be a good fit. Got it today. And again, I would love feedback. I do work very often with the Investing Pro team and they're always looking for feedback. So I hope that I can kind of be that voice for you guys. And I mean this. If you guys give me feedback on what you would like to see more of on Investing Pro, I can directly relay that message to the team. But to me, that is my biggest thing is that I love how quickly it updates now. That was one comment that I made for them when I first used the platform is that I wish it updated quicker to as companies report earnings. And I love, my favorite part, as you guys can tell, is having access to the pro research. I love understanding or getting a better understanding of the fundamentals of a business. Is the company growing in revenue or is it declining? For Intel, you tell me. It doesn't look like a growing company to me. From 2021 to today, it's dying. The only reason it's up based off of its price action is because of Trump's administration taking 10%, which I think is fine, right? There's hype with that. There's a lot of companies that are doing well based off of those conditions. But again, I'm okay with staying out. With that being said, enough yapping. We have the market getting ready to react. That's going to be in the next few seconds. Here we go. In less than 1 minute, FOMC rate decision. There's a 95% probability that the Federal Reserve is going to pause. If you want markets to go up, you want the Fed to cut rates. If you want markets to go down, you want the Fed to raise rates. I don't think that's likely, but we'll see. Again, we're waiting for the market to react. And then 30 minutes after is the press conference. What's your view on Netflix? Give me 1 minute. Let's watch this. And then we're going to have 30 minutes to kill because it's going to take 30 minutes for Jerome Powell to begin to speak. For those that don't have Investing Pro, I'll do a deeper analysis with you guys. Here goes. Let's see. There goes 12 o'clock. Arizona time. Rate decision is out. We going to the moon? Is that what you're saying? Mooning. Oh man, I feel too old when I say stuff like that. I want to talk about Carvana today. Look at that. Carvana down 20%. I love it. Here it goes. Market's consolidating. Rate decision has to be out. Let me double check. There it goes. NASDAQ market pushing up. Yep, 3.75%. Pause. So let's just make sure everyone is aware. The Fed has decided to pause interest rates. Yep. We all got that? Do I even need to type it out? Do you think we're going to get spammed with that question often? What did they decide? What did they decide? I'm just going to screenshot it and send it. Doubt that there will be much change. I agree. A lot of consolidation. Looks like markets were kind of correcting leading up to that rate decision, but we'll see. I think a lot of it will have to do with, I shared it on Instagram during the press conference to try to understand Jerome Powell's tone about up and coming rate decisions. Are they open to more than one rate cut in 2026? That is the big thing. That is what I believe is the big thing. Feel free to share your thoughts in the live chat, but that is what I believe is the big focus for today. Will they change their guidance for rate cuts because of the pressure that they are feeling from the Trump administration and cutting rates more? Here it goes. Oh, I like it. Is Intel going to begin to curl on over? Whoo! Are we going to do this? 5.5. What do we think? Intel's just been holding so well today. I don't know if I want to break my streak of just staying patient right now. Look at that. CoreWeave getting rejected. CoreWeave with a lot of hype for the past 2 days, finally giving some of it back today. But again, just a little pullback. Looks like it's getting rejected by that moving average. So still showing signs of lower highs and lower lows. All right. Now it's dropping. All right. I'm not going to trade. How about I just dedicate, right? In the next 30 minutes, you guys want me to stay live, right? In the next 28 minutes, it's going to take 28 minutes for Jerome Powell to start his press conference. And then he's going to speak for about 30 minutes. You guys want me to stay live, right? For the meantime, would you guys just like me to break down different stocks that you guys share in the live chat? And then I can use the Investing Pro software to give my 2 cents. Is that cool? We can talk a little bit maybe about Tesla, Meta, and Microsoft because they're about to report earnings today. Is that cool? You guys let me know. Oh, wait, I thought it was a lot of you. It's just one guy spamming SLV. Let's do it. I'm down to talk about it. Are we good? You guys dropping a thumbs up. We have over 2,000 of you guys here, and we only have 225 likes. I think we can at least get 1,000 likes. Now, is that too much to ask? Is it hard to ask you guys to click that little like button and make sure that you're subscribed to the channel? You guys tell me. There it goes, 400. Quick little jump. Seeing a lot of volume kicking in. We got you. Don't worry. I like that. What's going on, brother? Nice to see you. Let's do it. All right. Where's the NASDAQ market at right now? NASDAQ, all right, still consolidating within range. A lot of volatility. Again, this is why we talk about conditions like today are a little bit more volatile. It doesn't mean that you need to be scared. It just means that it might require a little bit more experience, a little less leverage. Normally, it's not meant for beginners. So that is why we give so many warnings, not to discourage you from not trading. Again, you're an adult. You can do whatever it is that you want, but just to be a little bit more careful. You would be surprised how many people get offended when you talk about risk. You're like, why are you fear-mongering people? It's like, no, I say I welcome it all the time. If you're bullish, buy more, right? But it's when you talk about downside risk that it sheds light, I believe, in their uncertainty. And I think that's why they get so offended. So it's unfortunate to see, but it is what it is. All right, let's go ahead and, I would love to talk about Tesla because it's about to report earnings. Let's do it. All right, without further ado. And again, if you guys have access to Investing Pro, and you don't really know how to use it, just kind of try to follow what it is that I'm doing with the platform, and you'll become more familiar with it, okay? Again, if you want to download Investing Pro, it's the first link in the description down below. And with the current sale, it does break down to less than $9 a month whenever it is that you're ready to join. Again, first link in the description down below. Let's go ahead and jump right into it. So the first one that we're going to talk about is Tesla. Tesla was recommended by someone in the live chat. Tesla reports earnings today after the market closes. It's very straightforward for me because I've been talking to, honestly, Tesla's probably one of those few stocks that I have been kind of talking about that I don't understand how it's still holding at these elevated levels that hasn't actually pulled back, right? Because every other stock, when we talked about Oklo, we talked about MSTR, we talked about all of those BS overhyped up stocks, all of those corrected. They were due for a correction. But Tesla is different, right? It is one of the Max 7 stocks. It is and ran by Elon Musk. He's about to possibly IPO with SpaceX. There is a lot of just hype around Elon, and it makes sense. With that being said, what are my main concerns from Tesla? So today, because it's set to report earnings, first off, it's trading at a premium. This is just in my opinion. You don't have to agree with me. I'm not here to try to convince you. But based off of its most recent earnings, from what the company is currently trading at, if we pull up Tesla here, so when we pull up Tesla, Tesla trades at a $1.44 trillion market cap. It trades at $430 per share. Again, a very elevated price level based off of, a general trading range. So I believe it's overbought. The part that I don't understand is it's trading at such an expensive price when the company is no longer growing. Its net income is declining, its revenue has not shown signs of growth, and its PE ratio is only getting worse, meaning it's becoming more expensive. My biggest concern, and this is the only point that, not that I want to make, but that I want to learn more about. We've heard about the Optimus robot for the past 5 to 7 years. I get it. We've heard about full autonomy. I get it. My concern with Tesla in this bull thesis is that this is the first quarter that Tesla will be reporting earnings without government subsidies. I want to see if its revenue, without being subsidized by the government and without handing people a $7,500 tax credit when they buy the vehicle, where's their demand at and where is their revenue at with their profit? If they can come in anywhere close to where they were before, cool. I can accept at that point that it's like, oh, wow, they're doing something different. But that is my big concern. That's all. That's all I want to shed light on. What does subsidized by the government mean? I had FSD, not impressed. No. Let me make this very clear. I love Tesla. It's still a company that I hold in my long-term portfolio. I've reduced the majority of my position, but I still hold it long-term. I own Teslas. I have owned a Cybertruck and a Model X. I love Teslas. I hate how much they depreciate. Let's be honest. And I love the new update on the full self-driving. I'm actually I don't hate it in that sense. That's besides the point though. We're talking about a business. We're talking about a business that's trading at a crazy premium, 284 times its earnings. When you ask the question of, well, what do I mean by it being subsidized by the government? This is the part that I don't believe, that I don't think a lot of people understand, is that when Tesla would sell a vehicle for every quarter prior to the last quarter, Q4 of 2025, they were incentivized by the government, meaning they would get paid by our government, our tax-paying dollars, which again, I'm not hating on it because it was a government program. They just took advantage of it as any of us would. I don't hate Elon for it. I don't hate Tesla. That's dumb, right? There's a thing that they could take advantage of, and they did. Great. They were able to milk it. They were making, I think it was like $3 or $4 billion. I want to get the exact number for you guys. Give me 1 second. Let me ask Warren AI real quick. You guys feel free to look it up. How much a year was Tesla making off of Government subs. I last time I read, it was about 20% of its overall revenue, which had to do with the majority of its net profit. Feel free to look it up yourself. Again, like this, I love having these conversations with you guys because it allows us to really understand how much it is that they make. So as of the most recent data from 2023 to 2024, Tesla's annual revenue is nearly $98 billion. Subsidies and regulatory credits now represent a much smaller fraction of the total because obviously now they're gone. In 2024, it would be roughly 1 to 2% of overall revenue. Tesla's core vehicle and business scales, content, profitability. Tesla has reported strong net income without subsidies. The Tesla report strong net income of $7.15 billion in 2024 and robust free cash flow margins. Even with shrinking subsidy income, Tesla maintained 7.3%. Okay. 13% EBITDA. Let's see. All right. Net income as a company. Subsidy shrinking, now rounding error, around 97.7 billion revenue in revenue machine. Okay. Where did I see the 20 billion? Truly. Let me double check. How much did Tesla make in 2024 off of government subsidies and EV credits? Maybe that's the thing. Wait, okay, that's the thing. It's the selling of the regulatory credits. How much did Tesla make in 2024? Because that's the last full year, because 2025, they only did it for 3 quarters. Tesla generated approximately $2.76 billion in revenue solely from selling regulatory credits to other automakers. That's the thing. That's the part that I forgot to explain. To my understanding, Tesla earned so much in regulatory credits that they were able to sell those regulatory credits to other automakers that had too large of a carbon footprint. So they often sold it to like companies like Chrysler and so on and so forth, right? And by selling those government credits, those regulatory credits to other automakers, they were able to generate revenue. And my apologies, I labeled it as just government subsidies, but they took those regulatory credits and then they sold it. So 2.76 billion solely from selling regulatory credits. My apologies. And again, $2.76 billion. And this is just, in my opinion, 2.76 of just profit when this company, if we look at it and go back to how much Tesla makes, right? When its net income is 5.14 billion, again, just my opinion, that's all it is. So you're telling me that this company, 2.76 billion, which is roughly half of their net profit. That is where I was uncertain of like, wow, a lot of that, not the top line revenue, it's $95 billion, right? Obviously they bring in a lot of revenue. Margins are roughly 7 to 10% for their vehicles. That's all part of it. Do you see where, again, that was just my simple concern of, okay, once they get rid of being able to get subsidized and sell these regulatory credits, which they still might have some, I think that was a conversation worth noting. Not that you need to be fully concerned, because we still have to see how much they have left and if they have fully sold off all of those regulatory credits. But to my understanding, those regulatory credits have ended, and that was on September 30th, if I'm not mistaken, of 2025. So this will be the first quarter where they're no longer able to receive more of that. That's all I wanted to shed light on. Well, the 2.5, does it go to revenue or net income? Well, does it matter, right? It goes into their overall revenue, but when you see that their net income is only 5.1, but they've made 2.7 of free money off of selling regulatory credits, that means that if they weren't able to sell those regulatory credits that cost them nothing, they would have half of their net income. That is, again, when I was reading the article that shed light on this concern, that is what was most eye-opening to me. It's not that it has to be full drive and panic or anything like that. I just thought it was a conversation worth having. You guys let me know in the comment section what you think. And again, please, if you're bullish on Tesla and you think that long term this really doesn't matter, I swear to you, I'm not trying to convince you to sell. Your positions are irrelevant to me, as I would say that my opinion is irrelevant to you, right? I thought it was a conversation worth having where I saw some signs of concern where something was about to end that makes up a lot of their bottom line. And that's why I made a video on it to shed light on it. I thought it was a conversation worth having. So let's go ahead. If you have any other comments on that, feel free to share it in the live chat. We have 14 minutes left until Jerome Powell goes live for the press conference. So let's go ahead and move on to the next stock. Dude, this day is so busy. All right, silver. Let's talk about silver. I feel like a lot of people, do we want to? I mean, silver's I feel like I already commented on it. Very attractive move, very bullish. I would say that if you're a trader and you know how to manage risk well, and you're a momentum-based trader, I see why you're paying attention to silver at these elevated levels. If you're a beginner looking to invest at a good deal, I do not believe silver is a good deal any longer. Just my opinion. When you look at silver on the 4-hour or you look at silver at the day chart, I swear, it's almost like now there's a cult of silver holders that get offended when I talk about this. Again, hold your silver. Buy more silver if you want to. I'm not trying to convince you to sell. It's just for beginners that are watching this. No, I do not think it is smart for them to buy silver as a long-term investment when that's their intention, when silver went from $20 per share or per ounce all the way up to $100. I don't feel like that's something that's like out of left field. I think that's just kind of looking out for a beginner. It's approaching this in a very level-headed way. Sure, silver can continue to pump, just like GameStop could continue to pump, right? But it's all momentum-based. It's short-lived. Eventually, it will correct. And when it corrects, the potential for loss is so much greater than the potential for profit. That is why I say it's not worth the risk to me. Make sense? Facts. If you miss the train, take the next one. And again, just because I don't agree with it being a good deal does not mean that I would short it. Two things can be right at the same time. I don't believe silver is a good deal, but I also think silver is bullish enough that I don't think it's safe to short right now. It has too much momentum, which is why I would entertain the idea of if you want to trade it in your experience, it makes sense. Make sense? Same. Gold, in my opinion, is a little bit different. I still think there's a lot of hype with gold, but gold is known to be cyclical. It tends to go up when markets go down. 60% of silver's demand comes from like industrial use. So it's directly correlated to its overall demand. Now it's kind of taken on a leg of its own, where now it's become so expensive that I wonder if these companies are going to have to look for alternatives, right? Because now it's so expensive that it's probably going to eat into the margins of all these companies that depended on silver being at $20 to $30 an ounce. Now it's 3 times that. So again, I would not be surprised if we see a shift. So President Putin has bought 20% of world reserves and is not selling to other countries until the next time. What Russia's analyst says, silver will see $100. Says silver will see $100 per ounce. So silver's already at $100 per ounce. Yeah. iPhones need silver. And humans need water. I don't understand that debate. They're like, but you don't understand. There's a huge difference between what gold is per ounce and what silver is per ounce. So what about what water is per ounce? Why isn't what, like, our life depends on water, right? We need to drink water. It's so valuable. It's like, why? It's not a 1-for-1. It's use case, it's utility and what it's valued at. Gold has always been significantly more valuable, and long-term it always will, than silver, because less than 1% of gold is used for actual industrial use, right? 50% is used for jewelry. That's not the case for silver. Over 60 or nearly 60% is used for industrial use. Again, two very different things. You cannot say, like, try to compare an apple to an orange and be like, well, it's the same thing and it should be trading at the same 1-for-1 ratio. Again, if that's what you think, put your money where your mouth is and feel free to buy silver if you think it's so cheap. It's not that it can't continue to push up, because yeah, you're right. Silver, I think it was at $113 per ounce this morning. Sure, it could run to 120. Maybe it could even run to 150, just like Bitcoin when it was trading at 110 or 120. And we made numerous videos of, sure, it could run to 125 or 130, but at what cost? What if it crashes to 100? What if it crashes to 80? The risk to reward isn't favorable. It's terrible ratios. It just doesn't make sense to me. But again, I respect your right as an American and as an investor to put your money where you see value. And if that's the case for silver, I promise you buying silver isn't going to offend me. I'm not trying to convince you that you need to sell. I'm just making you aware of, hey, I would take this downside risk into consideration. I think it's something worth, looking into. Copper is the best. All of these precious metals have taken a leg of its own. I think even natural gas, right? What is that? What's the ticker for that natural? It's like United States. What's the natural gas? I had it here. Is this it? UNG. Thank you, guys. Natural gas recently has had one of its most parabolic moves from $10 per share all the way up to $115, a huge 50% uptick. What's beginning to happen? Again, I'm not a rocket scientist, right? You don't have to be. But after momentum peaks, like, you guys know this, right? We're not trying to trigger one another. We're just trying to have a level-headed conversation. After you see a huge uptick and things begin to consolidate and show signs of resistance, if volume and hype begin to fade, what begins to follow? Profit taking, right? People begin to take profits. Panic selling begins to follow. And for those that are over leveraged, they get liquidated. And then we see a correction. That is often, not always, I guess, but that is often the cycle. So again, if you still think that it's a good deal and it has another leg up, I welcome it. Feel free to buy it if you think it's a good deal, right? But just weigh out your options. What's your profit potential versus your downside risk? Look at your ratios. Do they align with your risk tolerance? I think that's just a conversation to have with yourself. Okay? If everyone is talking about silver, it's already too late. I don't even want to say that, because I truly do. Especially lately, I've wanted to entertain both sides, in the sense that I hope that when you watch my videos, I'm never trying to convince you that you need to think like me, because that is not the case. There's many times in the past that I've been wrong. I mean, I don't agree with Bitcoin. I don't see the value behind it, but again, it's taken a leg of its own and it's excelled and it's done very well for itself. And I think that's great. There's a market for that. And for those people that are willing to take the risk. With any asset, even speculative assets, I feel like it's just our job to not just hype up every asset and how much higher it can go. But I wish that when I first got started and all I thought about was more profit, more upside, I wish someone kind of like just shedded light on, hey, just take the downside risk into consideration, not to convince me to sell, but to make more informed and calculated decisions. That is all. Let's go ahead and move on to the next one. What stock? Oracle. You don't want to hear my opinion about Oracle. Let me pull it up right now. Okay. Isn't Oracle the one that, yeah. Yeah. So strong retracement from the highs. This thing popped off. I think that was during the OpenAI strategic partnership that it announced, and every other Max 7 stock announced it too. So there's a lot of hype during that, and it's been a consistent downturn since then. It's been kind of slowing down and trying to find its support. I think the big concern with Oracle is on the fundamental side. A lot of people are talking about that it's over leveraged itself. If you look at Oracle on the fundamental side, you can see that now, according to the fair value on Investing Pro, now it sees potential upside based off of a series of 38 analysts. If we look into their metrics, the P ratio is now 32 times its earnings. But I would say that this is the main reason that we shed light on downside. When you see a parabolic move and a stock goes from 130 to 300, so it doubles in price in a very short period of time, we like to shed light on the downside, because when moments like this happen, we don't want you to be the person that bought up here and now is bag holding and praying for it to recover. I would rather be someone that now that it's sold off, now I have a conversation with myself of, okay, hey, do I want to buy the dip because I think it's a good deal and there's recovery potential? There's a value piece here, right? Or is this just kind of like the hype is over and now all this is going to do is to continue to sell off, right? You can look into the fundamentals, and by clicking at the Oracle Pro Research, again, we can quickly see, hey, I'm actually quite impressed. Revenue is increasing. I think the concern with this was that, let me double check. With a P ratio of 35, high debt. Yeah, high debt levels. That was the big concern when it came down to Oracle. I'll have to look into it a little bit more, but how high its debt was in comparison to its competitors, and how it wouldn't be able to sustain itself if we do enter a correction. This is one that I'm interested in learning more about, because again, I did not like Oracle when it was trading at $300 per share. Could I entertain the idea of going long on Oracle at 170? I would like to learn more about its earnings and what it's going to do what it's going to do to turn things around. I would love to learn more about it to see if it actually would meet my criteria, not just make a trade decision or investment decision based off of what's sold off now 50%. So now I have to buy it. No, that's definitely not the case. Nobody wants to refinance Oracle. Bingo. Yeah, I know it has to do something with its debt, and it's so heavy in debt that there's like a comparison. I'll have to follow up in one of my videos where they compared it that it's at worse levels than it was back in 2008. And to me, that doesn't, again, it sheds light on uncertainty, but also I don't want to just take one article or one perspective and make a definite decision off of avoiding Oracle. I want to learn more for myself, and then ask myself after I learn about it, the concern, is it still something that meets my criteria? And again, I'm only able to do that by actually understanding. Imagine only making decisions based off of charts. Imagine not actually being able to look at the data, not able to look at the, research where concern is pretty much shed, right? Areas of opportunity or pro tips in the sense of what's bullish about the stock, what's of concern about the stock. I can look into their overall LTM financial models of how it is that they produce revenue on a yearly basis, but then also per quarter. So big yap session. Nonetheless, Jerome Powell is about to go live. Let's go ahead and tune in. Okay. Let me pull it up here. Okay. Ooh. Looks like QQQ is experiencing some volatility. MSTR is down 2.3%. Is there ever a day that MSTR doesn't crash? I just want to know that. Even when markets are nearly at all-time highs, on any of my live streams, I have to say something about MSTR because of how terrible it trades. Maybe it's just me, but I literally just laugh. I laugh because it's hilarious that even when markets are pushing at nearly all-time highs, Bitcoin is still lagging, and the digital Bitcoin or digital gold still isn't performing well. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Here we go.
Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timros, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
I mean, what's your view on the market movements? I mean, what do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on it.
Again, once again, Jerome Powell really does a great job. Always has. Focuses on his job.
Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve Leisman, CNBC, and sticking with questions you might answer, thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rates, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. If you had a follow-up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, 3 Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Chair Powell, Mara Moakley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. we're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the two goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2% ex the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place.
Market pushing.
I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted. And I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals.
Oklo's up 10% on the
Risks to
day.
both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now. Anybody's base case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
I think that's bullish.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
I like that.
Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. Just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll jobs softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions.
All right, he's going to be speaking for another 5 to 10 minutes, but I'm going to have to go live with you guys in less than an hour because markets close, and that's when Meta, Microsoft, and Tesla are set to report earnings. So a quick little recap for those that tuned in a little bit late. The Fed decided to pause, was the rate decision. So they did not cut interest rates, they paused. In my opinion, he didn't sound incredibly eager to raise rates by any means. He said that obviously the Federal Reserve will do anything that is needed if the data supports it, but he pretty much said like no one's base case is to raise rates. That's kind of not, I don't want to say it's bullish. It's definitely not bearish though. The only thing that he said that can shed light of uncertainty is that when asked about the integrity of the Federal Reserve and if they will either give in or hold pretty much their independence, he says that, of course, him and the committee still intend to refrain from letting politics dictate what the Federal Reserve does. That's the only thing that can kind of get skewed into saying that there's some form of pushback to Trump. Other than that, he also kind of changed the idea of, originally, I think it was like 2 FOMC press conferences ago, he did say that like their bigger concern was the inflation rate rather than the labor market. And today he is saying that it's kind of now more equal, and now not one is more important than the other. That is not bearish. I would almost argue that that's kind of bullish. Again, not saying that markets have to push up higher. I'm just shedding light on his tone. His tone was definitely not bearish in my opinion. You guys let me know down in the comments section what you think. Yeah, most boring FOMC. Do apologize. Obviously, we don't get to control what Jerome Powell says, but I feel like he did a really good job not getting into politics. I wish everyone that was an elected official did or what he does in the sense of they don't talk about or comment on things and markets that they know that they can influence. He could have easily taken again, I voted for Trump, so I'm okay with criticizing him. The Trump approach of criticizing everything, knowing that you can influence markets. That is not Jerome Powell's tone. That is not part of his character. And I really respect that about JP. Again, that's my opinion. That's my 2 cents. I know based off of the comment section that some people just absolutely hate him. And that's fine. That's your opinion and you have every right to that. I'm not here to convince you otherwise. I really do respect that about him. Nonetheless, I'm excited to follow up to see how markets react after. It was a relatively pretty flat press conference and how the market reacted, but it still looks like it's kind of finding its support. It's really trying to recover. We'll see if into the close, you guys have 1 hour, less than 1 hour until markets close. We'll see if we get a rip up. But again, we have Tesla, Meta, and Microsoft reporting earnings. All $3 trillion companies. A lot of consolidation and a lot of uncertainty that can present itself. These big tech companies will set the tone for the rest of big tech. Apple tomorrow, and then next week follows, if I'm not mistaken, with Amazon. I'm very excited to go live with you guys, and all I ask you to do is hopefully I earned your thumbs up, and maybe you can consider subscribing. I do want to remind you, again, the software that we used to be able to analyze these different stocks is Investing Pro. One of the stocks that I wanted to talk about that I just didn't get the time to is Carvana. Carvana crashed 20% today. I would love to shed light and do a full analysis, not just technically, but also fundamentally on why I'm not surprised by this. There were some red flags that were presenting itself and very happy to see it. Again, if you would like me to present or do a fundamental analysis, I'm going to be using Investing Pro, and I would love that when I film that video, you can follow along with the software as well. And again, if you want to download it, it's the first link in the description down below, so you can download Investing Pro and start using it today, and it breaks down to less than $9 a month. Also, do not forget, if you want to watch me trade live as soon as tomorrow, that's my LPP team. Again, it's the only service that I offer. It's a one-time payment for lifetime access, and you'll get to watch me trade live every single day right at market open, except for tomorrow, because tomorrow I am traveling, so there will be no live trading session tomorrow. So just a heads up on that. But if you want to check it out, there's a huge discount. Second link in the description down below, and it's $300 off. I appreciate you guys' time. I hope that earned your thumbs up. Please consider subscribing. Wish you guys nothing but the best. And like always, let's make sure that we end the year on a green note.